Richard, for the remaining 10 minutes, let's go over case analysis. You can make the argument. I have spoken to a few of my investors. I'm sure you have too, because you have purchased rental properties in the markets that my organization is promoting. Florida, Texas, the Midwest properties. You have done it many, many years. You have multiple properties. You and I have the same kind of philosophy. So with that in mind, since you are a mortgage loan advisor, you know these kind of numbers, and you have a massive amount of experience working with your investor uh, finance buyers over the years. So I'm gonna go over this case study with you. This case study is happens a lot. This is a California buyer. He or she have a rental property or even a primary home at 800 grand fair market value. I mean, a rental property right now is rented for $2,500 somewhere in California. This person have a loan balance of 200,000 and their mortgage is 2,000. So of course, the equity is 600,000 and the mortgage rate is 3.5%. Now, before you will make any kind of comment, let me share with you the goals and the objectives of this particular investor. The investor wish to buy around 6 rental properties out of state, out of California. They want to cash out refinance or do a 1031 tax deferred exchange. They want to pull out around $400,000 of cash to finance those 6 properties. And the 6 properties, I'll give you a high level, it's not exact property, but I'm just sharing with you the type of numbers and the type of market. This one is in Florida, $325,000. If you rent for $2,300, all the numbers look good. 25% down payment at 6% interest rate. So initial down payment is 86 grand. The second property they want to diversify in Alabama, for example, $210,000 property, 25% down payment, $58,000 down payment. Rent is $1,580, and when it's all said and done, the monthly cash flow is $246 monthly. And then the third property, I'll make it quick. Down payment is 18 grand, 25% down payment at 7% interest rate, whatever. The monthly net cash flow is $224. And the fourth property, $73,000, somewhere in the Midwest, Buffalo or somewhere. Good rent to value ratio, 950 monthly rent, 25% down payment. Out of pocket is 24 grand. And monthly net cash flow, a little bit more than $200. Another property in Midwest. This is a fourplex at $249K. The gross rent on all 4 doors is $3,500, 25% down payment at 7.5% interest rate, mortgage rate for investors. See, it's not about the mortgage rate, investor. It's all about the cash flow. So monthly net cash flow, because this is a very high cash flow property market, the net cash flow monthly is $540. And then this one outside Austin, brand new construction, $320K, 25% down payment at 6% interest rate, monthly rent $2,200, monthly net cash flow is $106. And so with that in mind, let me go back to so now you hopefully so now I want to so this investor is coming to you, giving this scenario. It's kind of hard to digest all the numbers, but you get it. Just high level.
Like you said, it's the thing we deal with on the dealing basis.
Yeah, you do it all the time. So tell me, what is your proposal? What are the numbers? If this investor cash out refinance 400 grand, the new monthly payment on the loan or the property that have been financed, you have to look at the monthly payment. Then you have to match with the net monthly cash flow on 6 properties to be sure it makes sense for the investor. And then should the investor do a 1031, sell the entire property, get more cash out, do a 1031, buy the same 6 properties. So share with the audience, what is the number crunching, the offsetting numbers? Is this a good strategy? Especially when this rental property in California is locked in at 3.5% mortgage rate. That's the key driver. So I would love to hear your overall big picture thoughts.
It really depends on the numbers and what each investor's individual strategy is. If you can cash out of a property and the end effect of that payment is that it's not higher than the rent you're bringing in, but you're able to pull out, 2, 3, 400,000 and then turn around and deploy that into additional purchases. In every scenario, you're going to increase your net cash flow dramatically, especially taking assets, whether you do a 1031 or you cash out of a California property to out of state properties, you're going to see a, 2, 3, fourfold increase in your net cash flow. So, it definitely could make sense, and it does make sense. We do it for people, but it's a balancing act for everyone as well, right? How much can I take out of this property with it being self-sufficient still? And that's not needed, right? Some investors are a little more aggressive. They're like, hey, I don't care if it loses 300 here or 400 on the subject property we pull the cash out from, because I'm making $2,000 with the proceeds, right? It's more than going to pay for this negative. I have some investors who are a little more conservative that are like, hey, you know what? We only want to cash out enough to where the rent will still cover that proposed mortgage payment, which also makes sense, right? None of these are wrong answers, right? They're all right answers, because at the end of the day, the right investment really is the investment that you're comfortable with. But also strategies are different for someone who's 40 retiring in 25 or 30 years versus someone who's 65 retiring, ASAP. There's going to be a little different strategy. And that's where Seaway and I come into play to help kind of nail down the best strategy for your individual situation. But also keep in mind it's diversification, right? If you're in California, you've got all your money tied up in one asset, making you $1.5 million property, even if it's paid off, and you're like, oh, well, I get $4,000 a month in rent. Well, you could be getting $14,000 a month in rent if you diversify that property into 20 other properties across the country. So obviously, understanding and balancing all that out is very important. But it's especially from a California property downstate, it's always going to make sense. But the big thing is now you've taken all your risk from one asset to 10 assets, right? If you have one vacancy in your $1 million plus California property, then you put yourself in a position where if you have vacancy, you're in a tough spot. Whereas if you have 10 out of state properties, you have 1 or 2 vacancies, you still got 8 other properties rented out. So.
Yeah. And not only that, Richard, you have to think long term. To a newbie investor or non-investor, they think this is a high risk scenario. The short term, the net monthly cash flow from that 6 rental property will more likely going to offset the cost of refinance at whatever rates, percent, whatever. The number really works even on a short time. In my opinion, I would suggest do a cash out refinance, because I'd rather not sell the property, because when you sell any kind of property, I want to keep the property long term. This California property still rents pretty well. I'll do a cash out refinance instead of 1031. But it's a personal decision. But overall, long term, if you can parlay one asset into a 5 or 10 rental property out of state, over the long term, you and I discussed it many times. I've done many, many other videos where I tell people each income property have a multi-dimensional asset. It's the world's most attractive asset class. It's the world's most tax favorite asset class, because you make money many different ways. You could increase your rent. The renter could pay down your debt, systematically. And then you have a long-term appreciation. You have tax benefits. You can leverage, do a 25% down payment, all kind of great benefits. So long-term, the scenario we just painted really makes sense. So we're drawing to a conclusion about this. Any last minute recap about everything we talked about and how we can find ways to trigger all those investors that are still on the sidelines?
It's really get off the sidelines, right? We say that every time, and whoever's listened has done very well. Understand and know you're investing for the long term. So get away from the short-term data that's running out there, because you're not investing for the short term. Educate yourself, get on the phone, talk to C-Wing, talk to myself. People's fear right now is because they don't have any data, right? They're just going with headlines. So educate yourself with the data. And I think you'll see that now is as good a time as any to invest in real estate.
Very good, Richard. Thank you so much. Richard Advani from Guarantee Rate Mortgage. Richard, how can people find you?
Drop me an email at richard.advani@rate.com. I know you'll put the information in the description as well. Or you can call me at 949-294-0435.
Thank you so much, Richard. You've been very helpful, and see you next time.
Sounds good. Thank you.
Nice day.